Ready to rock and roll. All right. All right. Welcome to day number 7 of Money Momentum. 10 days of Money Momentum. Let me know that you can hear me, you can see me. Let me know where you're coming in from. I see some people on YouTube, Facebook, LinkedIn, and I see some people here on Instagram. Say hello. Say hello. How's your day going? How are you doing? It is Tuesday. Ready to rock and roll. Told my husband you had 2 granddaughters, and he said, poor guy, having to wait so long. Oh, man. So, good deal. Jamie, I'm doing well. So good. Thank you for asking. Grace Lovestrong is in the house. Hello, hello. And Melissa's in the house. She has been here every single time. She had a little thing yesterday, but so good. So good. All right, cool. We have 49 with 6 grandkids. Whoa! We got some catching up to do. So, all right. Facebook user, hey there. Good to be with you again this evening. Is this Joey? Let me know. It says Facebook user. Here's the thing. Copy. See if this does this. What you need to do to give permission, I think this is what you need to do to give permission so I can see your names, but that's all right. Coming in from tornado warning. Oh gosh. Well, stay safe. This is stay safe. All right. Cool. Let's get this thing going. All right. Welcome to this day number 7 of the 10 days of Money Momentum. Today we start to dig in, and we started to dig in. We talked about the prompt today was really it said about discipline, but it's really about rules. Okay. But it's the discipline that is going to keep you safe. It is the discipline that's going to keep you doing the things that you want to do. Let me just close that. All right. And really start to drive this, because we're going to talk about the rules. We're going to talk about the foundational rules of investing here today. So I'm going to give you those. There's that we can kind of walk through them. And we're going to talk about the things that you want to watch out for in investing. So we're going to start to dig in more tactically, and then in the next session tomorrow, we'll go even deeper on this. Remember, I wanted to layer this in small micro steps and micro exercises and micro successes. And hopefully you've been going along with me to stay along with it. And if you haven't, you can catch up, because we have all the replays on one page. Just go to melabraham.com/momentum to get yourself registered so you can get that link. There's nothing to sell. Ain't nothing to sell. I got nothing for you. Well, I got a bunch of stuff for you, but it's me serving these 10 days. So we're going to have the replays up for a period of time. And if you look on the replay page, underneath each of the replays, I actually have a worksheet for each of the sessions that you can do the exercise in and everything like that. So we're posting the replays right after we get done, right after they render and all that stuff. So it's usually up within an hour of when we get done. So now the nice thing is that we get a chance to go through this. This is about really resetting your money game. This is about what I call a money reset. Going into this year, at the beginning of the year, to completely transform where you're going, what you're doing, how you're doing this money thing, this money game. I truly believe that financial freedom is a birthright, and we just have to go claim it. I truly believe that we have the opportunity to live a life that is rich and fulfilling and fully expressed. And even if we never get to the ultimate destination that we're looking to try and get to, the journey feels a whole lot better when we're on the right journey, and we're on the right journey with the right people. And so this is how I wanted us to really look about it. We're going to talk about why do people lose money, so you avoid that. And we're going to talk about my 8 rules of investing. We'll talk about how I lost 1/3 of my net worth and what the heck happened there. And and really start to build it out. All right. So let's jump in. Let's jump in. In the question we got to ask ourselves, why do people lose money? And whether it's investment, look, not every investment that I've made has hit the jackpot. In fact, I've made plenty that haven't gone so well. But here's the thing that I do know. It's the ones that didn't go so well that I learned the most. And it's the ones that didn't go so well that created the principles, the rules, and the processes that allow me to be here today. And more importantly, it is what I teach. It is what is in my content. It is what we do through Affluence Blueprint, is what is in the upcoming book. It is allowing me to now give that forward, to push that forward in a way that I can pay it forward. If I have paid millions of dollars for a financial education by losing millions of dollars, y'all should benefit from that. You all shouldn't have to pay the same millions of dollars. I know where the potholes are, at least on my road. So let me make sure that you don't step in the same potholes. Are we good on that? That's why I want to do this. And so we're gonna jump. For those of you that are on YouTube, are on Facebook, you'll get a chance to see these slides. There he is. Drew is back in the house. You'll get a chance to see these slides. And it's really going to be me just walking through some of the reasons that people lose money in investments or in the stock market, or as you go to it. Now, this becomes a checklist for you. And it's a checklist for you to just determine, is this happening in your world? And if it's not happening in your world, great. Okay. So I'm gonna move to this so you start to see the things that we're trying to do. Now, the first reason that people lose money is they have no strategy. Okay. They have no strategy. Okay. What ends up happening, and I see this all the time because I'll get the phone call. I'll get a phone call that says, "Hey, I've got $10,000. I've got $10,000. Where should I invest it?" I don't know. I don't. Because I don't know your situation. I don't know your circumstances. I don't know if you have debt. I don't know if you have wealth. I don't know if you have kids. I don't know if you have a huge mortgage. I don't know if you're 60 or 16. All of that impacts it. And I certainly don't know your vision. And so what ends up happening is people are looking for this investment, that investment, this investment, that investment, and they have no strategy. And the reason they have no strategy goes back to partly what we talked about in session 1. And that is, they have no purpose for the money and they have no vision. So the first thing is that, because here's how this thing works. We create a vision financially. We get a vision for our life. Now, when we talk about it in the Affluence Blueprint, or when I work with my clients one-on-one or in masters, it's about making sure that you have a clear, vivid, compelling vision for your life holistically. It's not just, hey, I want to have $1 million, $10 million, $100 million. It doesn't matter unless it's attached to a vision. So we want to know the vision of your life. Now, that is health, that is wealth, that is relationships, that is, spirituality, energy, all of the things to be holistic, to truly make it happen. And the reason this is important is because from the vision, you will create the plan. The life plan, the financial plan. Because from the vision, we can put the price tag on it. We know what it's going to take to have that vision. Then from the plan, we create the strategy to make the plan the reality. And then And only then do we figure out the tactics. Where do we invest? What do we need to do? What's the right investment for you? Okay. So vision informs the plan informs the strategy informs the tactics will set the actions. Not the other way around. So one of the reasons people will lose money is they're opportunistic with no strategy. It sounds good, it feels good. I'm going to go do it. And they get involved in something that doesn't fit their risk profile, that doesn't fit their plan, that doesn't fit their strategy, that doesn't fit their vision, and it doesn't fit their criteria because they have no rules. And they wonder why it goes bad. Okay. So that's the first reason that folks will lose money. The second reason that folks will lose money is that they have poor advice, or they're listening to gossip. I remember, you're out there talking to the neighbor, and the neighbor says, "I got this great investment for you. It's insider information." Y'all should not be creating a financial or investing strategy off of gossip. Even worse yet, get on TikTok and here's this person that says, "Hey, you should go invest in Lambos." Don't get me started. Where are you getting your information from? Where are you getting your investing advice from? It certainly better not be gossip. Now, there might be bad advisors out there too, but by and large, in this social media world, you're going to hear things and you might think about investing in things, but you don't have the full story. And if you're investing from gossip or something like that, there is no strategy again. So we need to look at it from that perspective and avoid the gossip, avoid listening to what the neighbor says. Okay? It's kind of how I got into the Ponzi scheme. We'll talk about the Ponzi scheme in a little bit here. Okay? And so the third reason people will lose money is there's no consistency. Here's what I mean by this. Building wealth is a journey. But Drew says, "But what if you like Lambos?" Well, you can do it. It's just not going to be your path to financial freedom. It's certainly going to be a path, though. So your journey to financial freedom looks like a hockey stick, meaning that there's this flat zone. We call it the wealth flat line. And what ends up happening is that we need to be consistent with our investing, with our money, with our discipline to make sure that we can move past the flat line into the acceleration zone. The challenge is that many of us are inconsistent. We will make investments haphazardly with no strategy and not consistently. I'm effectively always investing, almost weekly, monthly. We're putting money to work. We're doing things. But more importantly, the more important thing is consistency in your behaviors. Remember what I said earlier in one of the other sessions. No one has money issues. I know. Mel, you haven't seen my checking account. I get it. But even if you have problems with your checking account, those aren't money issues. They're symptoms. Money symptoms. They're symptoms of the behaviors, the choices, and the decisions of the past. I get that can be confronting. I get that might be you going, wait, that doesn't feel good. No. It should feel good. Because then you're not just handing it over to the whims of whatever's going on. Because if it is a result of behaviors, decisions, and choices from the past, all we have to do is change the behaviors, decisions, and choices, and we got a different future. You're in control. But the consistency of behaviors, the consistency of putting money away, the consistency of looking at your numbers, the consistency of checking your net worth statement, the consistency of contributing to your 401k if that's what you're doing, the consistency of all of that stacked up is what's going to create the money momentum that creates the money machine. That's a great name for a book. The money machine that's going to give you the freedom you deserve. Okay? So we need to be consistent. A lot of people will lose money because they're inconsistent with what they're doing, and their behaviors give them away. Okay? All right. So number 4 reasons people will lose money is because they have no discipline. Okay, this goes along with consistency. Okay, and that is, but they got to have discipline. They have to look at it from the perspective of discipline. When they diagnosed me with the cancer, they told me, now I was a healthy, for the most part, a healthy eater. I still am, but I had a sweet tooth back then. We'll talk about that, Melissa. And so what they said was that sugars fuel the cancer. So I knew that I had to cut out the sugars. So I went on a 3-day water fast, okay, before my first surgery to make sure that I could break the tie with the sugars. And I'm sure that I've had processed sugar since then, but it wasn't by intention. So we have no processed sugar in the house. Okay. We sweeten things with any kind of natural stuff, bananas, things like that, pure maple syrup. But point being is that my discipline is this: no sugar. I avoid grains, I avoid dairy. And it's been that way since 2019. If we want to achieve something and we know we want to get there, we need to have the discipline to do the things to get you there. And it's that discipline is really the price that it takes to get there. Okay? So that's the thing. And you look at, like, even Drew just said that. He said, pay yourself first. Yes. Behaviors, pay yourself first. Discipline, pay yourself first. Okay. We'll talk about it, Melissa. I'll go deeper on this. It's really about the level of priorities and what you're doing. Okay. What happens, and I'll just go on this tangent for a moment. Here's what happens. Too often, what most people do is they get money in. I'm actually going to do a video on what to do every time you get a paycheck. But they get money in, and 1, because they don't have a cash resource plan. 2, because they've got bills to pay. They turn around and throw it in the checking account, and then just start paying things. And then they look at so they pay for their lifestyle. They look at what's left over, and there's very little left over, nothing left over, or some. And they turn around and say, well, I don't have anything to invest, and they don't invest. See, investing is not a priority. Paying yourself first is making investing a priority. Paying yourself first is making sure that you're taking care of yourself. When we talked about yesterday, and I said the non-negotiables, was one of them was self-care. Paying yourself first is self-care and making sure it's there. And so it's really important for us to really start looking at it from that perspective. All right. So the other reason that people will lose money is they follow the news. Oh man, don't get me going on this puppy, but whether it's CNBC, whether it's MSNBC, whether it's CNN, whether it's Fox News, whether it's, I don't know, KTL, it doesn't matter. Let's just get clear what their objective is. Their objective is not to give you the news, the unbiased news, so you can critically think and understand and make choices for yourself. What ends up happening is that their primary focus is to deliver ratings, viewers, and followers. And so what they do is they polarize the situation. They stir up the fear. They stir up the emotions. They get you all freaked out and looking at things. And all of a sudden, guess what? People are staring at the TV. They're staring at the computer. They're watching it over and over again. They're getting the ratings. They're getting the advertisers. They're getting all of that. But you're not getting all the truth. You might be getting a half truth. You might be getting part of it. And so what ends up happening is we start to make a decision based on the news. Now, here's the other side of it. Maybe they are giving you the truth. Maybe they are saying that, hey, the shipments for Tesla in whatever, Sweden, whatever, have gone down. Just so we're clear. That's old news by the time it gets to you. It's already typically in the market. So you're not going to win by taking the news off the TV and going and try to trade it. It's already been traded. So either the news isn't the full truth or the full story and it polarizes the situation, or it's old. Either way, it doesn't serve you. So we don't make financial choices based upon news, but a lot of people do. So the last one that causes people to lose money. Now there's plenty more, but these are the top ones. Is they have no safety net. They have no safety net. And here's what I mean by this is that when we make investing, when we do investing, what we want to do is make sure that we understand. So here's what I do with investing is that when someone comes to me and they said, I don't watch the news either, Melissa. So when they come to me, and you're so right, Drew, you know, the reason they have such a thing as reverse ETF of Jim Cramer. Oh my God, don't get me started. So when it comes to any kind of investment, one of the first questions I will ask before I ever buy is, what's my exit? I want to know how I'm going to get out before I get in. Because if I don't know how I'm going to get out before I get in, I'm not sure when to get out if it goes against me. And now I look at it and say, how am I going to get out? What if it goes against me? What are the alternatives? What are the options? What are the safeties? Now, if you're investing or trading, you can do something that's more technical. And I won't go into details here, but you can put what they call stop losses in. So it's this safety net. So if I buy a stock for $100 and I say, I don't want to risk anything more than 10%, you can put a safety net in that tells the broker, hey, it's called a stop loss. If this thing hits $90, get me out. And it'll get you out. So if this thing's tanking and it goes to 90 to 70 to 60, you should have been taken out at 90. Now, if it's moving fast, you won't get out right at 90. That's just the way the market works because it's moving too fast. But they'll get you out as quickly as possible. It'll trigger it. So the question is, do you have safety nets? Too often what happens is that people will invest in something and it starts to tank. And they're like a deer in headlights and they stare. They watch, and they watch. I saw something on Reddit a while back when First Republic Bank went down. And here's this guy who puts the graph up. And I have the graph. In fact, I have it in the book because I wanted to demonstrate it so you see it. I don't know if you can see that, but you see how it just dropped. It just dropped. Okay, it just tanked. Okay, and he posts in there and he says, "I've lost 50%." Of the value. Should I stay in it? What should I do? All right, y'all. First off, you don't go to Reddit for your financial advice. You don't. Come on. And then he says, I've lost 50% of the value. And then he says, it's everything I got. What? If he stayed in, that went from 200 to $3. He lost it all. No safety net, no alternatives, didn't know his exit, didn't think about it, didn't do any of it. That's why people lose. That's why people lose. So let's talk about what you're, if you're going to invest, some of the things to be aware of. I'm going to add a page here. Add page. Because I'm gonna write some of this out for you that are on the YouTubers and Facebook. So here's the thing. I want to give you some foundational rules. These are my 8 rules, my 8 foundational rules for you to consider. Okay, and these are the basics before you ever get into investment specific rules. All right. So the first rule, okay, rule number 1, at the beginning especially, no individual stocks. Okay. Look, here, I get it. You go, wait a second. What do you mean no individual stocks? Think about what I just showed you, the First Republic Bank. If that was everything they owned, which it was evidently, and it goes from 200 plus down to $3, they're wiped out. They're done. Okay. When you have an individual stock, you are concentrating the risk in one thing. That means it has to go up or you lose. And when you have stocks, like for instance, Tesla can move $10, $15 in a day. Facebook can move $10, $15 in a day. Doesn't happen every day, but if all of your eggs are in one basket at the beginning, you put way too much risk. Now, do I own individual stocks? Yes, I do. Full disclosure, I have individual stocks, but I didn't own individual stocks until I was in a situation where I had critical mass to my portfolio. So I have a large enough portfolio, and then I took a little sliver of it, and I said, this is where I'm going to invest in individual companies. Now, I have some that are large, good, strong companies that aren't, should not go to zero. And then I have some that are more risky, and I get involved in angel investing or startup investing and things like that. But that's a very narrow slice. Now, let's be clear. If those things go to zero, I'm going to pout for at least a weekend. I'm going to be in a bad mood for at least a weekend. But it's not going to destroy me. It's not me betting the whole future. It's not going to destroy our ability to pay our bills or anything like that. Okay? The second kind of rule, if you will, is to, number 2, keep it simple. This really comes down to, we do not invest in anything we do not understand. Do not invest in anything we don't understand. If it's some convoluted, complicated investment that you don't get, then we don't want to invest in it because you don't understand it. Now, if you're working with advisors, it is your advisor's job to help you understand. That's their job. So you can make an informed decision. It's not their job to make the decision. It's not their job to coerce the decision. It's their job to inform and educate, empower, and equip you to make the decision so you can make the decision. If they don't have the patience to do it, the tolerance to it, or the desire to do it, fire them. That bluntly, fire them. That's their primary job. Inform you, help you, guide you. Okay. And so this is the thing that we ought to be to look at. So we want to make sure that we keep it simple. It doesn't need to be complicated to make to build wealth. Down you have Here's the thing. As you grow your wealth, complexity is just going to find you. It's going to join you on the journey. It's just the way it is. So let's not start that way. Okay? All right. Next, rule number 3 is, this is a big one. Don't follow the crowd. All right. Especially, I mean, you see it with, Wall Street bets in Reddit. You see it on TikTok. You see it in social media. Don't follow the crowd. Just because they say it's a good thing to do doesn't mean that it's the right thing to do. When Wall Street bets started to play the game with GameStop, they said that they were doing this to do what they call a short squeeze to hurt the short sellers, and all of that. And so they were driving the price up because these short sellers were betting on GameStop going down. So they said, if we buy, the price goes up. And if the price goes up, they lose. And so great. That's what they did. It was a hugely bad idea. And so they just kept stirring the pot. Now, mind you, GameStop had no business at the price they drove it up to. It wasn't based on economics. It wasn't based on value. It wasn't based on operations. It wasn't based on profits. It wasn't based on cash flow. It was purely based on them driving it up through memes and posts and things like that. But what happened? The people that said, wait a second, hopefully I'm not late. And they jump in at the top because they're following the crowd. And now what happens? GameStop tanks. GameStop tanks. It's kind of like a pyramid scheme. The first ones in made a whole lot of money if they got out. But the last ones in, they were left holding the bag. Do not follow the crowd. Do not follow the crowd. Okay. Number 4, keep expenses low. Okay. So keep your fees and expenses low. It was a very expensive game of chicken. Certainly was, Drew. So keep your expenses low. Even the advisor fees. Okay. But let's just talk about the investments themselves. What are the fees inside the investments? If it's an ETF or index fund, it should be less than half a percent. But you can have fees that are 1, 2, 3, 3.5%, or even more, depending on what the product is and how it's being marketed. I will always ask, how are you getting paid? What are the fees? How are you getting paid? What are the fees? I want to keep the expenses low. Think about this. The lower the expenses, the more the money is there for you. It's not going to line everyone's pocket. Okay, so number 4 is keep expenses low. Number 5 is don't time the market. We have this idealistic view that I can predict the bottom and I can predict the top. Now, in a perfect world, you could pick the bottom, pick the top, you could be absolutely wealthy. But statistics have shown even the top managers long-term cannot time the market. And so if you're trying to pick the ins and outs from an investing standpoint, it's a fool's game. So we don't time the market. We don't time the market. We get in the market. This is why I end up I'm buying on a regular basis. Sometimes I buy it a little higher, sometimes I buy it a little lower, but I'm buying on a regular basis in our investments. We're constantly investing. We have the money working for us based upon a plan, based upon a strategy, based upon the vision to make that happen. And that leads to this other principle that we should realize is that the number 6 is investing is long term. Have a long term mentality. Look, the market is going to constantly in the short term go up and down. It's going to be volatile. Okay, it'll go up and down a couple hundred points in a day. It'll go up and down a couple hundred points in a day. But over the long term, the market goes up. This is why we want to have a long-term perspective. Now, there's a difference between investing and trading. I'm not talking about trading. I am talking about investing. Trading is a different animal, and we can talk about it another time. Okay? Then the last piece of this, the last thing of this is number 7. Well, actually, it's not the last. There's one more. No emotions. Yo, this is huge. This is huge. Why did I get in the Ponzi scheme? Because my emotions got involved. Here's this guy. He looks like a family man. He's got 3 kids. He lives in this beautiful house on the bluff in Malibu. He's really, nice, inviting, whatever. He did the whole thing. I'm thinking about it and going, huh. All right, this is good. Then he starts talking about the investment. He starts promising the world basically 20% returns every 6-8 weeks. And he shows me the documents and he shows me everything and everything. But what happened is I wasn't logically thinking it through. I wasn't watching it and everything. I just started let my emotions grab a hold of it. And so what do? I go, well, wait a second. I got 20% every 4 weeks. Holy moly. I'll pay off the house. Heck, forget paying off the house. We'll sell the house. We'll get a bigger house. I'll get a vacation home. I'm going to stop working. And I did the spreadsheet and my emotions just ran away with it. Now I'm a financial dude. I should know better. But the promise and the way he framed it, the pot of gold at the end of the rainbow, as Drew just put, the whole thing is out there in a way that I go, oh yeah. And I wanted it so badly that I ignored everything else. And my emotions got involved. And let me tell you, when your emotions go up on a financial decision, your financial intellect goes down. When my emotions went up, my brain power went straight to stupid. It just did. And I ended up losing, well over $1 million between me and 2 buddies. We lost $4.5 million, 1/3 of everything I own wiped out because I made emotional choices. Now, a lot of what I teach is around the lessons that came out of that, which then leads to this last thing is that you want to have an evaluation system or process or criteria, however you want to put it. Bottom line is you want to have a way to look at investments over and over again that is consistent to make sure it's the right investment for the right reasons to fit the plan and fit the strategy. I remember I sit on this board of directors, and I remember we're in a board of directors meeting. This is a company that was founded in the late 1800s. And their business development team comes in and they're presenting to the board and they're talking about all these opportunities that seem great. But the problem was that it was as if every opportunity was equal in priority, in possibility, in probability of success. I'll get to that, Melissa. And And so they had no criteria to say this one's better than that one. This is the right one for me. So everyone, and I have some things that are the 6-factor evaluation criteria and different rules that we use when we evaluate. And I kind of work through it with our folks in Affluence Blueprint and everything. But there is this systematic way to look at an investment that we use or you use if you get some. Point being is that you need to have a system to look at it. And you look at it through the same lens every single time. You don't change, you don't adjust, you don't tweak, you don't do that, because what happens is when you do, you tend to then adjust things to fit what's going on. Let me explain what I mean by that. You decide you're going to make an investment and you believe that you're going to go into the investment, the plan. Remember I say know the exit before the entrance. So let's say I'm going to buy this investment, this stock or this whatever. Let's just call it a stock. I'm going to buy a stock at $100. I expect it to go to 120. If it hits 118, I'll get out and take my $18 and go home. Okay. Yes, I'll leave $2 on the table because pigs get fat, hogs get slaughtered. Okay. Then I look at it and say, but if it goes against me and it hits 90, I'll get out and I'll take a $10 loss. And I think it's going to do that because earnings is coming out in 2 weeks. So I get in, I know my entrance, I know my exit on the upside, I know my exit on the downside. It gets to earnings. Earnings aren't what they thought it was going to be. Not only does it go past 90, it ends up at 75. So what do? I change my rule. And I say, well, instead of holding it for 2 weeks, I guess I'll hold it for 2 months and see what happens. So what'd you do? You changed the criteria midstream. And you will almost inevitably get hurt when you do that. Follow the rules, follow them strictly. Okay. When we look at investments now, I have the rules. I could leave $1 billion on the table. I will pout more than a weekend if I do. But if it doesn't fit the criteria, it doesn't fit my portfolio. Period. End of story. No discussion. I don't care. People will call me up and say, I've got this investment. I said, don't bring it to me. I got no reason to look at it. It has to go through certain due diligence before it even gets to me. And if it's just some hey, the neighbor 2 doors down has got this cool company and everything, I don't want to look at it. And it's that blatant. It's that important to sit back and say, set your rules, set your criteria, set the discipline beforehand so you don't end up losing 1/3 of what you own or more. People that got in that Ponzi scheme, look, here's the thing. There were people that lost their existence. I at least had the possibility to recover. In fact, in 18 months, we recovered it and tripled what was lost based on what I teach. The problem is that when we look at it, is that these other folks put their life savings in it and they had no chance of recovery. They're destroyed. You look at FTX and all of that went on. You had pension plans in there, had no business being in it. I'm on a pension committee. We're running $50 million. We're not going anywhere near crypto because you know why? The beneficiaries of that pension plan are people that are depending on that money when they retire. And we have to be conservative. Could we make a killing if it went for us? Yes. But we destroy it if it goes against us. So we manage a certain way. What are your rules? Make sure you have them. All right. All right. That's what I got for you today. All right. We've got another one tomorrow, but I see some questions I want to take. I want to take some questions and answer them. Melissa, you have a few questions. Let's hit on some of these. Let me go back a little bit. If you have questions, pop them in. Let's rock and roll. Hopefully this helps. Hopefully you're starting to look at things and say, what are my rules? What are my rules to get in, get out before I even do the transaction? All right, so let's go back. Da, 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 da. My goal is to get another 100K working every year. Yeah, he's on top of it. He keeps on top of it. Um, just finished a 36-hour fast this morning. Next one starts in 44 minutes. Uh-oh. Go eat, man. Get something in your system. All right. I don't want you news. Let me see. All right. Are you your own investment agent? Melissa's asking me. No, I'm not. Well, I can't say that. That slice of the portfolio that I do that. The the rest of my major portfolio, the critical mass portfolio, I am the one that is making the decisions with my wealth team. They go execute. They inform, they help me and everything, but then I make the decision, they go put it in play. So I have someone that's running the bigger part of the portfolio for me. They're executing on it and managing it to the criteria, managing it to the plan, managing it to the strategy based on our discussion. So I just met with them in October for the year end. We went through it. We stress tested everything. Remember, we talked about having a safety net. We stress tested everything to know what happens if the market goes down 30%. What if I stop working? What if I stop earning? What if it goes up 30%? What happens to the numbers? We stress tested it 100 different ways, 1,000 different ways, 10,000 different ways, because they used a Monte Carlo simulation to do that. And then we came up with the plan. We came up with a strategy. We adjusted it. And then we said, all right, what are the tactics we're going to use? What are the action steps? Great. Who's doing what? You're doing that. I'm doing this. Good. Break. And we go. Then I have that slice of my portfolio. That's just me. I make my decisions. I'll do it daily. I'll do it weekly. Depends what I'm doing. And I make those decisions. I report back to them probably every quarter and just let them know what my gains are and all that stuff and the income so they can put it into the equation for our tax planning meetings and all that stuff. So, great question. What is this? Melissa said same with angel investing. So when I'm looking to do angel investing, I am the instigator going out with specific criteria of what I'm looking for in an angel investment. I'm not sitting in a room having people pitch me. Okay. Um, and so I'm not soliciting for investments. But the more successful you are, they're just going to come your way. And sometimes I'll look at it and say, maybe it's something that I'm using that's a new company that I'm using. And I go, I like this company. I like the way they do things. I think I can have an impact on this company. I'll reach out to the founders, have a conversation, say, look, you know, can we make something of this? But I'm not sitting there just getting solicited investments all the time because I just don't open myself up to that. Okay. Do you tell them what to do with your slice? No. So I have the slice of so I have the major. If you think about it, I've got this. I got my major portfolio, the major piece of the pie, which is all my future, is here. Okay. My wealth team is the one that executes this. I make the decisions on all of it, but my wealth team is the one executing on it. Then this sliver, okay, is my fund. Okay. This is only me. They see it, they know it because we have it in a portal so they can see what I'm doing. But I actually make the choices, make the decisions. I do whatever I want in it. And then what I do is based on what I gain, I just report it back to them so they can put it into the equation for planning purposes, and that's it. So usually just for tax purposes as we're going through it. Do you tell? Okay, criteria. You answered that. Yeah, poor Stephanie. So, other questions? Criteria. I mean, what do you mean, Melissa, on the criteria? Tell me more. I may have answered it already. I think I know what you're asking. They know the criteria, and we discuss it, and we know that this is the characteristics of what we're looking for with respect to that. Oh, your fund? No, I have my own criteria for it. They don't really need to know it. I do it, and I look at it on an investment by investment basis. Great questions. Oh, love it. All right. Did I miss any other questions? If you have other questions or have things that you want to talk through, let me know. Let's solve it. That's what we're here for. That's why I stay on. Let's see. Why check your net worth? So one of the reasons I'm going to check my net worth, but it's really not my net worth. So there's a nuanced version of net worth that I use. Your net worth is basically everything you own and everything you owe. And a lot of people will focus on that. The problem with that is that actually isn't the number that I think is important, because everything you own includes your house, your cars, things like that. Okay. But those assets, what I want to focus on is the net worth that has the ability to produce cash flow that allows me to live. It pays for my lifestyle, my living, and the things that I want to do. The house certainly gives me a place to live, but it isn't generating cash flow. So it's really costing me. So I don't think of it as an asset from what I call an investable asset perspective. So I look at investable net worth, so I know the size of the machine that can produce cash flow. My investable net worth is 5 million. In other words, I have 5 million in investments and rental properties and things like that that can produce cash flow. And on average, the 5 million is producing 8%. That's $400,000 a year. But if that 5 million includes $1 million home that I'm living in, well, that $1 million isn't going to produce any cash flow. So the net worth is the investable net worth is basically the size of my money machine that allows me to live. Okay. We want to build this in a way that you have a machine that becomes your ATM, because Drew's right. Cash flow is king. I want to make sure, because we can have a whole bunch of assets. And this is what happened with a lot of folks that got themselves in trouble in 2008, is you end up with a bunch of assets. But if those assets are not liquid, in other words, I can't turn them to cash, then I can't use them to pay my bills. I can't use them to survive. And if they're over leveraged, that's even worse, because now I can't even pay the bills. So the reality is that it's not to have the large amount of assets that matters. It's to have the assets that can produce the cash flow that matters, because it's the cash flow you get to live on. It's the oxygen to your life. So, but we need assets to do it. The key is this: when you take the money you earn, remember we have an earnings machine. That's your wages, that's your business, that's your salary, whatever it is. And we take a portion of that. We build the second machine, the money machine. Great name for a book. Just so you build a money machine. The money machine is where you take the money you earned. Remember, you earned it. So you put your labor in, you put your effort in, you drove to work. If you work, if you're not working from home, you're working the late hours, you're working the overtime, you're dealing with the bad bosses, you're doing all of that stuff to earn this money. And then we take a portion of it and we say, hey, I'm gonna put that to work for me. And over time, that money will produce more money. Remember, we did that in one of the sessions, that we want to go from time for money to money for time to money for money. That money will produce more money for you. And when your money is working harder for you than you did for it, you will find yourself in a state of financial freedom, because it's producing more income than you could produce from your efforts. No, not that gold is a bad thing. Yep. Not that gold is a bad thing, but a pile of gold isn't something that you can be easily used to eat. Certainly not. You're going to break a tooth on it. So great questions. These are so good. Thank you for you. Loved the teaching yesterday, Melissa. Thank you. Thank you. Any other questions? Any other things going on that we wanna touch on before we sign off for today? Oh, we. All right. Tomorrow we'll dig a little bit deeper. Okay, we're going to get more into what are the priorities for every dollar that comes in. What do you want to do with it first? What are we going to do with it first? So we'll start to talk about that as we get into it, and and uh, and all that stuff. I heard the market is going to crash and that China is going to take over with oil. Are you listening to news, Melissa? I mean, there's all speculation about all kinds of things, but I'm not gonna. What's the alternative? What are we gonna do? Okay, the market will go down. We will have a correction. That's what markets do. It will go down. I promise you. I just don't know how far and I don't know when. But I can guarantee you it will go down. And I can guarantee you it will come back up. It's what it does. I just don't know when and I don't know how much. And if someone says they do, run. Now, granted, we are in an international economy now. It's a very different game. And the things that other countries do will impact us and affect us. And it's important for us to understand that. And we have to look at it from the bias perspective. Say who's giving us this news? What's in it for them? What do they get out of it? Is there a bias? Those kinds of things. And then we need to do our own investigation. Okay. It doesn't matter. It doesn't matter what political aisle you're on. It just doesn't matter. But I think that what we need to be really careful about and mindful about is not allowing some of that to create the emotions in our world and start thinking through it. Now, there's also some faith involved in the sense that I believe in the good of humanity. Now, you might say that I'm rose-colored glasses. I also believe in the innovation in America, and that we are survivors, we are revivers, and we will find ways to continue to thrive. And so I believe in that. If I don't believe in that, I shouldn't be investing in the stock market because then I just don't believe in the innovation of companies to grow. And so the very premise of what I do is that I still believe in large part what our economy stands for. Okay. So yeah. But I mean, is it possible that the market's gonna go down or China's gonna do something? Yeah, it is. And we had the Twin Towers go down. We've had wars. We've had different occurrences. The thing that we just got to make sure is no one pushes the button. I mean, ain't coming back from that. On the other hand, plan on giving charity. It should be part of your financial journey is generosity. Whatever those charities, whatever those causes. The reason that we want that financial freedom is to be able to get behind the causes, movements, missions that we love and adore, and to be able to give to that. And so I think that we ought to have that as part of the plan. Me, I have a charity against abuse and violence against women and children. Animals are a big cause for me, and I have a soft place in my heart for youth. Awesome. Yeah. Essentially use criteria, shut off the emotions when investing. Use the criteria. Here's the other reason I have advisors. If I feel my emotions going up, I send it to my advisor. Say, hey, check me. check me. They're the ones that will keep my emotions in check. Okay. Um, and I'll run crazy things by them at times, and then I'll run things that they go, "Really, you're asking us this?" Like, yeah, I asked them in October. I said, "Hey, I want to get a new car." They go, "You're asking us about buying a new car?" I go, "Well, you know," and they laughed about it. They said, "Just go buy the damn car. You're fine." So, yeah, but I lean on them, just to check me and say, "Hey, am I making an emotional decision? I don't want to make an emotional decision." Cool. All right, y'all. Tomorrow morning, 8 a.m., we'll drop another prompt. It's going to be a fun one. We've got 3 days left. All right, and I'll be back here with you 4 p.m. Y'all have an amazing, amazing evening. I don't know about you, but I'm having fun with this. I am having so much fun being able to do this. And for those of you that don't know, I'm probably bringing back my money mentoring on at least on a weekly basis in February. I haven't figured out how I'm going to do it yet. If I'm going to do it this way, I actually would love to do it maybe just in a Zoom room, private, so I can see your faces instead of this, and we can have conversations. So I just do a regular show, live show in Zoom, uh, with an open invite for folks. So I'm playing with that idea. Let me know. All right, y'all. You have a blessed evening. I'll see you tomorrow. Cheers.